Wednesday, November 22nd, 2017, Monaco 64, home of alternative economics and contrarian views. So I'm going to talk about the markets this morning, see where they are, and talk a little bit about debt. And the UK budget is supposed to be announced today, the autumn budget by the Chancellor of the Exchequer, who is the equivalent of the Minister of Finance or the U.S. Treasury Secretary. So it's 8:15 a.m. in London, and right now spot gold is $12.83, up almost $3. The range has been $12.79 to roughly $12.85 overnight. Silver is trading right at $17, up 4 cents. The range has been $16.93 to $17.05. The Dow is up 17 points at 23,600. The S&P is unchanged at 2598. So, and the Nasdaq is up 2 points at 6378. So we made all-time highs in all those three indices yesterday: the Dow, S&P, and the Nasdaq composite. But looking at the Dow transports, the all-time high is still October 12th or 13th, I think. So that's not confirming. I've spoken about that, the Dow theory. But right now it looks like the stock market is just in breakout mode. We could continue to go higher for no particular reason. Technically, the charts look very bullish. Can't argue with it. Currency-wise, we've got cable at 132.50, up 11. That's sterling. The euro is 117.65, up 28. So 1/4%, and the dollar is down 40 pips or 1/3% against the yen at 112.04. So that's probably what's helping precious metals a little bit there. In terms of the pound, recently we've tested the 130.50 level. It looks like we're holding that level. There's an upward trend channel all this year. In sterling, and it seems to have held that. So that's the key technical level below 130.50. What else? Oil. Yeah, oil doing very well today. WTI crude oil is up almost 2%, at 1.75%, or up 100 cents at 57.84. So pretty good move by oil. The bond markets, have a look. Bond markets haven't really done much in terms of, the 10-year yield. We're still at 235. I've always said that 263 is the level to look at. But there's been some heavy flattening of the yield curve. And what does that mean? Well, that means that the longer-term rates have been not going up or not going up as much, or dropping quicker than the shorter term rates. So for example, the 30-year bond yield is now 275 and the 10-year is 235. So the differential is 40 basis points, which is huge. It's a huge move. It's a very narrow difference. I spoke to a old colleague of mine from the city a few weeks ago, and he was telling me that, Mario, we just broke 50 basis points in the 10-30s spread. And he said that's quite significant. And right now we're at 40. So what does that mean? That means that investors don't think the prospects for economic growth going forward are that good. So that's why the curve is going like this. If the economy was doing really well, the yield spreads would be probably increasing, and the curve would be steeper. So that's something to keep an eye on. People have been talking about this for the last few months, though. The flattening yield curve, and the fact that the stock market is still going up while the curve is flattening, and there's a huge discrepancy there. But I think it's unusual. So the other thing I wanted to talk about is that today we've got the UK budget. And, you know, one thing I'd say about the UK situation is that they're going to use the Brexit situation, you know, the Brexit vote last year, decision to leave Europe, the European Union, and then now all the difficulties negotiating the UK's, you know, divorce from the EU, a lot of uncertainty, and that will be used as an excuse. You know, and I talked about that. If you look at the videos I made last year in the run up to Brexit and after Brexit, that it would be used as a scapegoat for the economic woes. But I think the economic woes, you have to go further back to see the origins of it. I think you have to go further back into, you know, maybe 20 years when New Labour took over and hugely, you know, increased the size of government, increased, you know, facilitated consumer borrowing, you know, which resulted actually in the collapse of '08, where, you know, the UK banking system had to be saved by us, the taxpayer. So we've incurred about £1 trillion of debt since 2010, actually, extra, even with the supposed conservative, you know, party in power since 2010, who was supposed to be imposing austerity. We've had another £1 trillion of debt created. I think the national debt was around 800 billion when they took over, and now it's almost 1.8. So, but it was unfortunately the Labour government that kicked off this debt frenzy, credit frenzy, and I'm not actually blaming any of those parties. I'm just saying when it happened, I don't think the Conservatives are any better. They haven't improved anything. What else? Well, so yeah, the national debt has kept going up. And, you know, the deficit was supposed to be plugged by 2015. That was what Chancellor Osborne, ex-Chancellor Osborne said. But we're still running a deficit, annual deficit. What that means is that we increase the debt every year because the government can't seem to spend less than they, you know, take in from taxation. And the other thing is, well, the GDP would be negative if we hadn't had those deficits because the GDP calculation uses the deficit, you know, the government spending as part of the calculation. So if the government spending deficit is 5% of GDP, that means that if they had been, the spending had been balanced, GDP would be lower by 5%. So they've kept GDP positive by this heavy borrowing by the government. The other thing that they've done to make GDP look better is that they have undercalculated the cost of living or inflation, because that's also calculated into real GDP. You got, you know, nominal GDP minus the increase in prices, and you get the GDP. And the numbers they use are ridiculous for the, you know, the inflation. It's probably more like 1 or 2%, while inflation, according to the RPI, is running at 4%. And RPI calculates council tax, which is the, you know, local taxes. It calculates the cost of housing, mortgage payments, rent, and those are big chunks out of everyone's, you know, budget. So I think the UK economy is in a lot worse shape. They did not allow for creative destruction in 2007 and 8, and I wouldn't have expected them to. You know, they're politicians. They never want things to get really bad, or else they don't get reelected. So what we've had, they've saved all the banks. Oh, and I forgot to say, there's another 500 billion pounds in debt that, you know, was put on top of us. In addition to the extra trillion in the last 9 years, this 500 billion was, you know, incurred by Gordon Brown, Chancellor, and Alistair Darling as well, to save the banks. But they keep it aside in the accounting. It's not included in the national debt. So our national debt is actually way over 2 trillion, and and we're told that as a percentage of GDP, it's not as bad as during, you know, in the aftermath of World War II or the Napoleonic Wars. But the fact that they have underestimated the calculation of inflation for the last 20 years, and they've kept GDP artificially high, you know, just goes to show that it's all a fraud, in my opinion. And that's why the economy doesn't feel good. That's why you go out there on the high street, or Main Street, as the Americans call, and all the shops, a lot of shops are closing. There are new ones coming on, of course, but they don't last more than 2 years and they close down. That's why tax receipts are really low. You know, if the economy was doing as well as they tell us, we wouldn't be running budget deficits. So it's whatever is said during the budget doesn't really matter. What does that mean for the future? I think it means that we're going to have a rude awakening about what things are really doing. And I would say that the only thing that's keeping things going right now is financial assets, you know, the stock market, low interest rates, housing, that's the flip side of the coin of low interest rates. It allows people to carry on huge, mortgages still, and keeps housing prices artificially high. When that flips, it's going to be quite scary. And this is not just for the UK. This is all for the United States. It's for all the other OECD or developed countries, as they're called. I mean, one thing you just have to look at, with RPI at 4%, retail price index, and I would even say that that's probably fudged. So with inflation running between 5 and 10%, how is it that, the 2-year yield for UK gilts, the government bond, is at 0.47%? How is it that the 5-year gilt yield is at 0.75% or the 10-year at 1.27%? They're just destroying, the currency, the pound or the Bank of England note. And it's even the 30-year 1.81. I mean, if you change the name of the UK to, let's say, all the statistics are on a piece of paper, and you change it to Venezuela, and they saw all the debt, all the budget deficits, and the GDP numbers, and, the tax receipts, they would probably say, wow, your interest rates must be really high. But then they'd say, oh no, how can you pay 1.27%? It should be more like 10%, our 10-year yield interest rates. And there will be a consequence. They can't keep lying because that, or fudging reality for much longer, because people are going to wake up. Even big investors, they're going to wake up. And something's going to happen. Of course, they'll blame Brexit for it, but it's not. It's just we've got ourselves to blame, and the banking system and the monetary system. Why do I say ourselves? Because a lot of people play into it. They don't realize, and they take on the huge mortgages. They take on the credit card debt. They perpetuate the system. So if you enjoyed this video, please like, share. Subscribe to my channel if you haven't yet, and you can also follow me on Twitter and on steemit.com. I'll talk to you later. Bye.